Many traders are either unaware of the importance of divergences or are unable to accurately apply the divergence concept. A divergence occurs when the price and the indicators provide conflicting signals by moving in opposite directions. If you spot such a situation, it could be worthwhile taking a closer look at what is really going on. In today's video, we'll talk about divergence trading, and I will share 10 important rules you must follow to profit consistently from market divergences. First rule is to use the right indicators to spot divergences. Most of the technical indicators used to observe divergences are momentum oscillators, but some indicators are better to find regular divergences, while others are suited for hidden divergences. From my experience, oscillators that are used to determine whether a market is overbought or oversold are more effective for spotting hidden divergences. Stochastic indicator and the RSI are perfect to find hidden divergences, which happens when the technical indicator shows a new extreme, but the corresponding price action doesn't. For example, in this bullish hidden divergence, the stochastic makes a lower low, while the price makes a higher low. In essence, when the price is higher than it was before, the indicator is lower, suggesting the market is much more oversold. In a hidden bearish divergence scenario, the stochastic makes a higher high, while the price makes a lower high. Hidden divergences are also called continuation divergences because they are used to trade the continuation of a trend. For regular bullish and bearish divergences, I found that the MACD histogram and money flow index are very effective to find such patterns. Bullish divergences are used to trade a change in direction from a downwards move to an upwards move. They occur when price creates a lower low, and at the same time the technical indicator, the MACD in this example, is making a higher low. In essence, the MACD is not following the price down, suggesting the move lower is weakening and losing momentum, resulting in a possible move higher. Bearish divergences are used to trade a change in direction from an upwards move to a downwards move. They occur when the price creates a higher high, and at the same time the indicator is making a lower high. In this case, MACD is not following the price up, suggesting the move higher is weakening and losing momentum, resulting in a possible move lower. Number 2. Adjust the settings of the indicators to identify divergences more easily. For any given divergence indicator, there will usually be different settings for different markets and different settings for different time frames. Let's say you prefer trading hidden divergences with the RSI. Here, the first two RSI settings were able to spot the hidden divergence, while the smoother RSI with a longer period was unable to find it. So remember this. Higher lookback periods on indicators will not suit hidden divergences. The same for regular divergences. Larger settings will produce a higher lag. Of course, there will be periods when market volatility and momentum cycles will change, and the indicator settings you have been using will be much less useful, so you may need to slightly shorten or increase the lookback period to find the optimal divergences. Number 3. Only take divergences in the direction of the main trend. With regular divergences, the oscillators indicate momentum shift and thus pointing towards a reversal of the trend. This implies that a regular divergence warns the end of a trend is expected. Hidden divergences signal momentum coming into the main trend, suggesting a possible continuation in the main direction of the trend. Now, the reason why so many traders fail when taking divergence signals is because they take counter-trend signals. They spot a regular divergence and immediately think the market will reverse. A smarter way to trade divergences is to identify the main trend and find divergences that go along with the trend. In the case of an uptrend, you ignore bearish regular divergences, those appearing at the top of the oscillator, and search for bullish regular divergences. In addition, you also concentrate on bullish hidden divergences. In the case of a downtrend, you ignore bullish regular divergences and search for bearish regular divergences and bearish hidden divergences. In this way, you have a high probability of a successful divergence trade. Number 4. Always wait for price action confirmation, meaning a trendline breakout. While using divergences is a great tool to have in your trading toolbox, there are times when you might enter too early because you didn't wait for more confirmation, and a divergence signal always needs a confirmation. If you keep entering divergences too early, you'll keep getting stopped out and you'll slowly rack up losses. The best confirmation is a trendline breakout. When a divergence forms and the price starts changing direction, and breaks a trend line, there is a higher probability the price is going to reverse. This example shows a bullish MACD divergence with a confirmed trendline breakout. So for better results, you just wait for a trendline breakout or a support or resistance breakout. When you see price action breaking a major level, it could signal a shift in power from buyers to sellers or vice versa, and that a price reversal might occurring. Number 5. Take divergence signals from support and resistance levels. To avoid trade entries that don't go anywhere, I highly suggest you add another criteria and confirmation tools to your arsenal. Besides the trendline breakout, the location of divergence is very important. Adding the filter of location can usually enhance the quality of your divergence signals and trades. Instead of taking trades just based on a divergence signal, you'd wait for the price to move into a previous support or resistance zone, and only then look for divergences and trend shifts to time your entries. In this example, you see an uptrend with 2 divergences. However, the first one completely failed, and the second one resulted in a massive winner. What was the difference? When we analyze the big picture, we see that the first divergence happened in the middle of nowhere, and the second divergence formed at a very important resistance level. As a trader, you first identify your support and resistance zones, and then let the price come to you. Such an approach will impact your performance in a big way. Number 6. Confirm divergence signals using volume. Volume is one piece of information that is often neglected by many market players, especially the beginners. However, learning to read volume brings many advantages and could be of tremendous help when it comes to analyzing divergences. To correctly read the volume data, it must be seen in the light of what price is doing. So the implication of trading volume depends on the price movement. If the price is rising in an uptrend, a divergence is visible, but the volume is reducing, it may show that there's little interest in the asset, and the price may reverse. Similarly, when the price is rapidly declining and forms a divergence, but the volume is low, it could mean that the institutional traders are not interested in the price direction, so the price might soon reverse to the upside. A high volume after the divergence usually indicates more interest in the asset and the presence of institutional traders. A divergence confirmed by a rising volume represents one of the safest trades. Number 7. Find confluence with common moving averages. No matter how appealing a divergence signal is, don't take the trade without confirming the signal with some other type of analysis. You can do this by using confluence. Confluence forms in a spot where you have more than one indication of where price will go. For example, confluence occurs when price reaches a commonly used moving average. If in that point you see a divergence forming, you confirm your direction with the moving average, and you will have a stronger signal and a higher probability of price going your way. Here is another example. When price touched the simple moving average, we have a hidden bearish divergence on the RSI, and the RSI reached overbought area. Number 8. Use higher time frames to trade divergences. Divergence signals tend to be more accurate on longer time frames because you get less false signals. This means fewer trades, but if you structure a trade well, then your profit potential can be huge. Divergences on shorter time frames will occur more frequently, but are less reliable. This is why I advise you to look for divergences on the 1-hour charts or longer. Of course, there are many divergences on lower time frames, but on those time frames, there's just too much noise, and the probability of a divergence to fail is higher. Number 9. Use Ultimate Oscillator to trade multiple timeframe divergences. The Ultimate Oscillator combines short-term, intermediate-term, and long-term price action into one oscillator, and offers divergence signals that might warn of future price reversals. It basically measures momentum for 3 distinct timeframes. The second timeframe is double compared to the first, and the third timeframe is double compared to the second. Even though the shortest timeframe carries the most weight, the longest timeframe is not ignored, which reduces the number of false divergences. The Ultimate Oscillator generates fewer divergence signals than the other oscillators due to its multi-timeframe construction, so the market noise is greatly reduced. Of course, while the multiple timeframe trading method for the indicator may help eliminate some poor trades, it also eliminates many good ones. Therefore, it is sometimes necessary to change its settings to reduce sensitivity and increase the number of signals. Number 10. Don't force divergence trades. When trading divergences, you must be careful and precise with your entry point. If you spot a divergence, but the price has already reversed and moved in one direction for some time, the divergence should be considered played out. You missed the boat this time, and it's better to stay aside and don't force a late trade. All you can do now is wait for another swing to form and start over your divergence search. Why? Because if you enter late, you alter your risk-reward ratio for the trade. When trading divergences, the entry point and risk-reward management are both important aspects that any trader should become familiar with. If you miss a divergence entry after the price rejected a moving average, for example, and you decide to enter after the price already moved a lot, you will have to increase your stop loss. And if the trade doesn't have much profit potential, you will have a hard time managing your trade. Remember, there are always going to be other divergence opportunities. The key is to be patient. If you found value and learned something new, leave us a like to show your support. Make sure you subscribe and click the bell icon to stay notified when we release new videos. Until next time.